loan refers to borrowing a few hundred or maybe a few £1,000s, but you do not need a guarantor as part of the criteria. Typically used for short-term emergency expenses, a payday loan involves you, the borrower, applying directly with the lender, and you are assessed based on your own personal income, credit score, and affordability. Because it's used for emergency purposes, a payday loan only is used for a couple of days, usually 2 weeks, or maybe 6 weeks most. When you actually receive your pay date next from work, that's when you pay off your loan. In our guide below, we explain how a payday loan is different to a guarantor product. The main differences are the amounts you can borrow, with a payday being only a few £100s, and guarantor loans being as much as £15,000. The loan period is also different, with a payday loan only lasting a couple of days or weeks, and a guarantor loan lasting as long as 5 years. The costs are also different. Because payday loans are used for shorter term emergencies, they are a bit more expensive. You can get the funds on the same day if you need to, whereas guarantor loans may just take a couple more days. We explain the difference in the application process and criteria. Above all, a guarantor loan requires you to have a guarantor, that extra person involved in the process who agrees to back up your loan if you cannot repay it. So during the application process, you need to go out and find a guarantor, usually a family member, a friend, a work colleague, someone who you can trust and who is willing to back you up financially if you cannot repay your loan. We also discuss the costs in some more detail and how repayments are made, either in one go or in monthly instalments. For more information, you can read about what happens if you miss repayments, and also a bit more about the industries and our policy on how we select lenders that feature on our website.